I welcome the next panel on the topic housing bonds in the current market situation. So housing bonds are a special product in the surety market. And on this panel, we will discuss the particular challenges of underwriting these products in the European market for MGAs. So Lara Biermann will moderate this panel. And over to you, Lara.
Thank you, Robert. So thanks for tuning in. We have 40 minutes to speak about housing bonds in the current market situation. And I'm very pleased to introduce three people who are very well known in the market, very experienced. So we have Annette de Groot. She's head of Surety Europe for Dual. Simon Barker, director of Nexus Europe. And Alessandro Rizzo, who's the founder and CEO of Eurocaution. So thank you very much for being with us. And maybe I do believe housing bonds are quite a special animal in the market. Everybody has heard of them. No, not everybody really knows what it's about, the product, how it works, why we have it. So Simon, would you give us a little introduction on what housing bonds are?
Housing bonds are obviously construction bonds, so they're part of a surety's construction portfolio. They are a retail customer-focused product for buyers of new homes, and usually private individuals. Because of the way that the construction industry works, there is always a shortage of capital, and building is very capital intensive. So builders and property developers will look to their buyers to part fund the cost of building. And that involves paying advance monies or installments during the period of the construction work. But clearly, they don't get the keys until it's handed over and completed at the end. So the regulators and the legislators think it appropriate that obligatory bonds, mostly obligatory, are put in place to protect those payments the customers have made. Now, bonds may be either in the event of a failure of a developer, some sureties or in some territories, there may be a requirement or a culture of completing so that the buyer continues to pay those installments through to the end, but the project is guaranteed by the guarantor, the surety, or if that becomes impossible, then it's just a reimbursement of those expenses made. And there's another small side to it, is that obviously under any construction contract, there's a maintenance obligation, which can be anywhere from 1 year in many markets to 5 years in some markets, particularly in Scandinavia. And the bond is required also to ensure that the contractor returns to site, meets his obligations under the maintenance guarantee, and if he fails to do so, the bond can be called for that purpose, and the guarantor then foots the cost of meeting those, rectifying those defects. So it's very much a consumer-focused product to that extent.
Thank you. So I think I'm speaking for everyone who's listened to you now. Sounds like a very complex product, actually. So maybe we start with Annette. Like, what special challenges are you facing when you distribute and underwrite housing bonds? Again, it sounded quite, intensive work.
Well, as you mentioned before, it is a different animal amongst all the other bonds. It requires a lot of project underwriting. And for that, you need a lot of information. Like you would like to understand that, for instance, when you underwrite the project, cash flow statements, the budget, you need copies of the building permit. You want to have proof that the land is owned. Also, copies of other insurance, construction insurances in place in case of some defaults during the project. So you do require a lot of information to be able to analyze it. And as you mentioned also, it's for the issuance of these kind of bonds, it depends if you have to issue a bond per dwelling. Like we are active as Dual in Spain in the housing bonds market and in France. In Spain, you require a bond for every single dwelling. So if you have a project of 150, you need to really investigate every agreement and issue a bond per dwelling. In France, you have the CMI bonds, which we don't have any appetite for, but you need to issue also a bond per project of per buyer. We do issue the GFA bonds, and their bond is required for the whole project. Also, the work's not done once the bond has been issued, so monitoring is key. You need like a report on the progress during when the bond is live. Also, there are dedicated accounts where the installments of the buyer are being placed. That needs to be managed. And you would like to have an update of the cash flow, of if still everything is in order. So it contains a little bit more work than the common traditional bonds, but it is different per country as well. Not the investigation, but the bond requirements, and that's all. It depends on the legislation. So.
So Simon, I know you've been active across Europe, even overseas. Like speaking about geographical differences, would you give us a little bit of an insight what that means? Why are there geographical differences, and what are they?
I suppose the country that has put more legislation and practice into this area is probably France. And France is a very consumer protective sort of society. So it's probably considered as the more rigorous and the more detailed of all territories. I think that's a fair observation, isn't it?
Yeah.
And in France, buyers will pre-fund up to 100% of the building cost. Whereas in other countries like Spain or Italy or the UK, and I think in Belgium as well, the installments, the amount of advance payments may be limited by law. So the builder then still requires his own capital to complete. The UK market, for instance, it's typically a 10% upfront deposit, which is held with the solicitor. In a country like Italy, it may get up to sort of 30% or 40%, but rarely beyond that. That's the general outlook. So France certainly is the most advanced and substantial in terms of the legislative coverage.
Interesting. Alessandro, I know we spoke a lot about customer profiles, but I see it in your face. You like to add to the geographical differences as well.
Yeah, to add, in our countries where we are active, Luxembourg and Belgium, it's in reality copy-paste of the French law.
Yeah.
And it hasn't changed since 1977. So when you have a claim, you need to explain to the beneficiary that it's not like in other countries, because due to internet, they're comparing. It's a bit difficult. But the developers changed. It's not a contractor buying piece of land and developing a residential real estate. It's more and more, and when we speak about us, 50% are co-invested by investment funds. So financial people developing real estate project, and the difficulty is, in this case, either for us or a bank, is to assess which collaterals we can get at what moment. And this is today the big change and the difficulties in our markets. And in our markets, you need the guarantee is given unlimited, but it's unlimited minus what the beneficiary still needs to pay to get this building. Unfortunately, due to the complexity and a law which is stating from 1976 or 1978, often reimbursement, there's no option, because it's impossible to continue the construction purely for legal reasons, or for some, and very rarely for material reasons.
Interesting. So we were supposed to discuss the current market situation of housing bonds, actually. So would you give us a little bit of an insight? How is the market looking at the moment? Are there differences in between the different countries?
I think that the markets are generally quite subdued. We've seen huge inflation of cost. We've seen a lot of dislocation of the industry during the pandemic. we've seen rises in interest rates, which is then choking off the amount of new demand because people can't raise the mortgages. Certainly in a country like the UK, the rate of new housing is at a historical low. And it's very low in France as well. Italy has brought in some tax incentives to stimulate demand. But the problem about a tax incentive is it's a little bit like a drug. It kickstarts everything, and then there's a great big drop off when the tax incentive is finished. And then usually they discover that there are issues with the tax incentive that have created systemic problems in their own right. What they were designed to do doesn't always have the effect that they wanted. So I think I don't know, Spain is a market that you know well, and that, of course, is a historically famous market for the housing and construction bond industry, for those with long memories.
Yeah, well, definitely.
Yeah.
And that's why I think in the market, housing bonds have a bad connotation.
Yeah.
Because during the financial crisis, with these 1 billion of losses, that is
Quite a number. Yeah.
that was not supportive of this housing bond industry. But in Spain in 2016, the legislation changed. So the bond you issue nowadays, we haven't had any losses since 2016, and that was if you claim this bond, you're not you don't have any rights to own the property. And usually it takes, around 2 years to develop a project. And in these 2 years, the price of a house is rising. So you lose this, amount you virtually gained. So, there's not a tendency to claim these kind of bonds. So it's, you still need to properly underwrite it, of course. So it remains a specialized product. But we hope with the improved legislation that it will have a more positive reputation.
In Belgium, even with the increase of the interest rates, the demand is still there.
Right.
And the reason is simple: the interest rates of mortgages didn't increase that much in other countries, because Belgian banks decided to remunerate less investors.
Right.
So you still have very interesting rates on the mortgages of 10, 20 and 30 years, and banks are still financing a lot, so there's a lot of sales, there's a lot of project launching. It's difficult for us insurers to get the market, because banks are always selling their construction loan together with the insurance, but there's a lot of investors, so that's where we have the place. Luxembourg, who have been seen the El Dorado of the real estate for many years, with incredible figures. 3 years ago, all the projects were pre-sold before they started to work. Today, we just achieved 30% maximum. So they need construction loan. Our banks are not ready. The state, the last 2 governments made wrong decisions for 10 years. So the new one now are actively investing in the market. So they're buying project from developers. So there we, as guarantors, insurer, we play a massive role. We have new vehicles co-financing projects, tax purposes, but they have been done for the one buying first property, not to incentivize investors too much. And the most important in our market is that the demand is extremely high, but the offer, so the price of the real estate, is not very high. And it dropped by 25% in less than 1 year. So now we have a stabilized market, and but the beneficiary lost faith in we call it installment payment buying of real estate, because they don't know when the project starts or they don't know when the project finished, and it's important for them to know that. And the market change is very important, and we playing an extremely important role to assist that market.
Okay, thank you. So for everybody online who's now entertaining the thought of getting into the housing bonds business and is not afraid of the obstacles that we just heard about, would you give us a little bit of an insight into how profitable the market is? Are there differences within Europe?
The UK market has had some quite significant losses, but that's across the whole market, both commercial and residential. And UK sureties have suffered quite badly. In the French market, one particular area has had a particularly difficult time, which are the regulated private house builder market, called the CMIs, the individual house builders. And that's a sector that's been particularly badly affected. There have been a lot of insolvencies, and therefore a lot of calls on bonds in that particular area. But I would say in the main in France, and Ed, you're in this sector as well, for commercial sort of multi-occupational dwellings, blocks of flats for all intents and purposes, that market has remained reasonably solid, and certainly our experience is it's been profitable. Demand is a bit slack, but it's been profitable. But been profitable because actually insurers have spent the time managing the risks carefully, managing the cash flow payments of the developers, and making sure that actually the project is running to time, and not running into exposures like happened in 2008. It seems to be a particular period that's stuck in our minds as surety people. But in 2008. Bonds were issued on properties that were 30 or 40% pre-sold. Now you almost have to be into north of 60 or 70%, and with additional counter guarantees and loan and capital to make sure that actually fundamentally that project is pre-financed 100%. So that's a profitable sector. And as you say, Spain has been profitable for you.
If you look at France, France did suffer a bit of limited building permits that were granted, like 30% less.
Yeah.
So it does depend on the political situation. And because of these interest rates rising, difficult to get these mortgages. So we did see some delays in housing projects being developed. So we had to be a bit more selective in the underwriting part. But there were still, because there's still a huge gap between the demand and the supply of housing, there's still a solid request of housing bonds. And margins are improving as well. Also, after the inflation of the material cost, that has calmed down as well. So it's an improved situation.
Yes. Well, certainly developers need to rebuild their balance sheets. It's also said that some of the developers may go down into the small housing market if they've rebuilt their own balance sheets. They may occupy the ground that's been left by the individual house builders. So.
Depending on the markets, in Luxembourg, Belgium, more than 50% of the market are done by very small developers. So we're also real estate agents or project manager developing two projects. So the underwriting is totally different in these cases. You need really to assess that even if tomorrow there's a default of the developer, that either the building can be completed, that the margin is not taking out before the project is completed, and that moment even a claim can be a profitable element. In Luxembourg there was no claim 30 years, and now we have claims, banks or insurers, and we realized that we as insurer, with the underwriting we are doing and the collaterals we can be even running a claim profitable, because as we need to complete the building or pay for completing the building, but the beneficiaries needs to pay. So if there's a lot of margin, or if there's margin left, but we as insurer don't need to pay, because the building will be completed with the money of the beneficiaries. So we need to be we are very careful in what we allow to our developer, which in France is not possible, because in France there's much competition and a little bit developers dictate the rules. In Luxembourg there's not much competition, and we decide, okay, we want that project manager, we want that construction company. So we are sure we are arriving to the end independently what happened during the construction.
So I have a feeling like the risk assessment is a very tough part for you all to do on a day-to-day basis, right? With these housing bonds, are there any other challenges that the market is especially confronting insurers with? 'Cause we will speak about the role of banks in a couple of minutes, but just yeah, for you as insurers, what challenges is the market bringing towards you? Maybe just a brief overview.
The monitoring, the monitoring is changing. It's we need to rely on third parties. We need to rely on fintechs offering bank account services. We need to rely on credit data coming from third party. We need not to have only financial underwriters, but also engineers who knows what is a construction. And this changed, and this is a big challenge to recruit these people.
I think also, I mean, there's quite a few new developers or entities that consider themselves as developers coming into the market, and they're not well known, they're not well tested, and so they are new experiences, new risks for insurers to look at. And where you might have worked with a property developer for 10 or 15 years, you know them, you know their track record. There's an amount of knowledge that you have about how they run their business. If it's a new firm, and dislocation in the market, there may be old firms that just wind up or retire, and there may be new firms that come with people who are less experienced or less well known, and those become difficult risks to do. And quite often, if they're new businesses, they don't have the capital to offer you the counter guarantees, so you're into quite a complex way of managing it.
We see also industrial companies active in chemistry or other activities. They have a lot of brownfields. They have a lot of land, and they develop themselves. They get developers for developing cities, and then they are asking other construction companies to make project on it. And this is a big challenging, because they are not from the work. So you need to ask, with who are you working, with your advisor, with your architect. And the process is early in the housing bonds when you need to intervene.
Yes, I mean, I think that's true. I mean, a property developer will look at something and say, well, maybe I don't need an external project manager to run my project, because I can be my own project manager, I can do it myself. But actually, the more you strip it back, the less controls and experience there are in running a project. They may decide to restrict the amount of consulting engineers that they use for looking at sort of structural aspects or ground aspects, and then those put pressure on them. So the insurer needs to make sure that actually all the right array of professional parties, soil engineers, structural engineers, concrete engineers, they're all in place, so that there are enough checks and balances in the project.
Okay. So I know when we had the first discussion about our panel, especially Alessandro and you, Simon, were quite passionate about the part of the bank as a big competitor within the market. Could you give us a little bit of an insight how the market situation is? Why are banks the biggest competitor?
They have money. So as Simon said, developers is a cash-intensive business. So when you have lower pre-sale rate and you want to develop your project, it's not in the role of an insurer to take a commercial risk. So we need to be sure that either they have own funds or other investments, or when a bank is coming saying, I'm borrowing you 40 million euro, they usually say, I want a completion bond as well. And this is unfortunately a reality, and it's changing, because banks have limits and caps, and Basel III and maybe also Basel IV, some will in any case forbid that. But it's today the main challenge. So we could be much more present in the markets, Spain or France or Belgium, Luxembourg or other ones, if banks would make a better fair play game.
Yeah. I think banks also, banks are banks. They're not construction people. So I think it's within the DNA of a surety to basically expect that any one moment a claim is going to come. And I think if one can evidence to the bank that actually the surety brings value, because they are insurance people. They're used to rectifying, adjusting, quantifying and rebuilding or completing, and that's within the mindset of the surety.
Yeah, or any insurer, we know what is a claims adjuster. They don't know that. So
Yes.
Yeah, true.
And don't forget, property insurance. If a building half burns down and needs to be reconstructed, it's the insurer who oversees the reconstruction, appoints project management and so on. But ultimately, so they're used to that process of indemnification, rectification, and rebuilding or completing. And if that was better appreciated by banks as added value to the project, I think that would give more scope.
and it also avoid to the banks to syndicate loans because projects get bigger and bigger and bigger. It's a request to build cheaper, so we need to build bigger, and syndication is also expensive, and making deals between a bank and a surety giving completion bond, housing bond, and the bank the financing. It's going to be more and more. It starts, so it's good, but I think for myself we could go be faster.
So, Annette, let's cheer a little bit for the insurer side. So, why should I get more involved with an insurer if I need a housing bond rather than a bank?
Sureties are really the specialists. So, for instance, in case of a claim, it's not that you pay immediately. You do investigate, and of importance and key is service to. For if you need a bond, they need it yesterday and not tomorrow. So you have to respond quickly, and that also counts with a claim. You also have to be involved quickly if you have to complete the house, and it might take another year. Then the claim situation, the loss situation, will become so bad. So I believe that as a specialist. We are in surety, we can provide the best services, the quickest one. We're not always the cheapest, but you don't need to, I believe. And yeah, as you mentioned, the bank, if they provide project financing, then they make it contingent to that a bond needs to be provided as well. And that's hard to compete. In that case, it's for the developer also cheaper. But if they do perceive our added service, as important, and we would not just claim, because in case of a claim and we need to pay, there's always we always try to reimburse this with the developer unless he's bankrupt. So and that's the key. Yeah, we haven't mentioned that, but I always teach around me, especially if you're part of a company where insurance is more important than a banking product like surety, that we do have recourse, and therefore, as Alessandro mentioned, it's very important to the counter guarantees, the collaterals, the securities, and that we don't compete on that we always remain very strict in getting these parental guarantees and counter guarantees. Personal guarantees is quite common even in the French market. So
even in Luxembourg, Belgium, I think they trust if they trust in the project, they're willing to give the right guarantees. But it's our role to assess that they didn't give the same guarantee to many people. So
country like Italy, it's all personal guarantees because it's all small businesses, all privately owned, and basically the business doesn't really have any money. The owners have the money. They're the guarantors. And you have large schedules of family members acting as guarantors for projects, and that's just the nature of that society and the tissue of that market.
So I see there are a couple of advantages I would have to go with an insurer rather than a bank when I want to obtain a housing bond. But
and also you've got a second person that you're dealing with as well, because if it's all dictated to you by the bank, you either take that, or you have two parties that you're working with, which gives you some margins for manoeuvring.
So as far as I understood, you have other competitive advantages on the insurer side as well. So you do have the knowledge, but you do also have the tools, right? Compared to a bank, like we've been speaking quite intensively about how you are underwriting.
Yeah.
You have tools in place for risk analysis, underwriting. Maybe you would like to give us a little bit of an insight on why that is such an important advantage compared to a bank.
But banks, for example, don't have a portrait to request a bond. It's a bank guarantee. So it's a paper. In our countries, Luxembourg is still a paper process. I think we have a portrait. But we have portals since ever. It's like saying since the years I'm in the insurance sector, there exists portal, paper request, certificate request. So this is very important because, as Annette said, they're calling in the morning for the afternoon. So this is the one element. That element, what we don't need to forget, in most countries, the insurance is off balance. So it allows you to keep your bank lines and more money to buy property, because the developer needs to buy land to develop it. So if you're stuck in your bank, say, I can give you more money, then you have a problem. And this is a big advantage for us.
Yes, I think that's. Yes, I think it's a fair observation. Yes. Just looking at the sort of the other advantages that a surety has compared to a bank. A bank is an insurance surety is part of the fabric of the insurance industry, and therefore there is a familiarity with the other insurance products that are required. If you take most countries now, a 10-year defects guarantee is required on the building by law. It's in most European countries now. Came out of the French legal system, essentially, and that's mandatory. Well, that actually is a very important policy that sits aside of the bond, because that also can cover aspects of defects. And if it's actually if it's a technical defect that causes a default, the insurer then has the ability to call on that policy as well into force. So there is some mutualization across other insurance policies. And indeed, the importance of making sure that a builder actually, takes out a contractor's all risk policy, because the last thing you want is it to go up in a puff of smoke the day before handover, because that's 100% loss, and the builder won't have the money to rebuild it. So you do need a culture of insurance to understand what array of insurances are required, that all the professional parties are all correctly insured with all their policies, because you still have your right of subrogation. As a surety, you can go after those policies and make sure that everybody is properly insured. So it's a risk spreading exercise as well. And I think it's probably better understood by a surety than it is by a bank.
Okay. So thank you so much for analyzing the current situation. But maybe we focus a little bit on the future. So I know all three of you have been into the market for many, many years. You're quite passionate, I would say, about the product we've been discussing the last half hour. What do you think? How is the market going to develop in the future? And how much do you think the insurers will play a role in deciding where the market is heading rather than banks?
I think depending on the countries, and Annette was told, the legislation is evolving. Customer protection is an extremely important part for politicians, and depending on national events, a claim who was a bit mediatized will create new legislation. And the bank can issue a simple completion bond, but when you need to add reimbursement guarantees, defect guarantees, when you need to add maybe more coverages, it gets too long, and the insurer will play the role. And this is what happens in our countries. Legislators are making new laws to more protect the customers, and banks just realize that they can't follow. So when this is going to happen, it's very, very good that this happens. Customer protections, and we just need to adapt.
And there's a growing demand in housing, so meaning there will be also in housing bonds. Also governments on their political agenda, the housing sector is very important also for economic stability. So we believe there will be a lot of investments, public investments in social housing.
Yeah.
And we did discuss that before. We like to support these social housing projects. Usually the margins are a little bit less, but it's 100% pre-sales. And if there's a good developer behind.
Our largest beneficiary is the state of Luxembourg.
Yeah.
And it's still AAA, so But the developer's margin is very low. So you need still to monitor really a lot that they are not using the money for other things than developing their project.
Yes. The disciplines are still there.
Yeah.
You don't run the commercial risk of a commercial project where you say, okay, we'll issue the bond. You've got to 70% pre-sales. We know the other 30% will come.
Yeah.
You know it's 100% sold. And actually, for many property developers, that's actually, you might want a blend of the two because actually you've got some spread. You've got some larger profit in your private deals. And if you're building for social housing, you've got low profit, but at least you've got a 100% buyer and a buyer who is state-backed.
Yeah, exactly.
State-backed. So I also believe that, one of the issues for builders and developers is that they need to start looking at making their balance sheets more robust, and that means actually that they are going to have to start to increase their prices. They already have increased their prices out of necessity, but holding that profit, retaining that profit on their balance sheets, because the stronger their balance sheets, the better audience they'll get from sureties. And they won't have to pledge their own personal liabilities. They can pledge the company liabilities, and that will be a better outcome overall. So balance sheet rebuilding.
Let me jump into there. So we actually, as you were talking about balance sheets, we got a question from the audience, and somebody would like to know what makes the risk analysis when underwriting housing bonds so difficult.
It's more project underwriting that you have to do, and usually the balance sheets are not the best ones.
No.
It's not that these companies are very strong capitalized. Some are the larger corporates, but we're with the GFA also in very active in the SME market. So you really have to understand what kind of securities you can have in place, and understand the projects and the experience of the developer. We sometimes see, a good balance sheet, good project, and then we look at the experience, and there's limited experience. Then we decline on that case. And
developers are very leveraged, and they don't consolidate their balance sheet. So you need to look on the left, on the right of the company. So because if they got 100 million euro bank loans from property, maybe on one side the developer has is pretty profitable. So financial analysis is not enough. So this is just a small part of our daily job. The big part is to assess the people doing the job.
And actually, you're looking at the build cost per square meter. You're looking at a lot of details. You have to be prepared as the guarantor to substitute that developer and replace him, and you become the builder. So you need to know that what is being built is technically correct, that it's going to be well project managed, and so on. At any moment, you have to be prepared to substitute.
Yeah, also the complexity of a project.
Yeah.
Have they done that before, or is it just straightforward?
Yeah.
So
Interesting. It's almost as if you've already read the audience questions. Because another question actually was like, we've all understood how complex it is to underwrite, but how do you deal with the complexity? How do you get it under control?
Process. You need to tell to your customer exactly what you need from day one. Not just give me 5 documents. It's a process. You need to be precise. Digitalization. You can and you need to be part of the market. You need to ask general contractors how much it costs. You need to have benchmarks. You need to have databases. You need to follow up and not going to insurance event, but to construction events and conferences. And this is the processing.
It's not enough just to look at a developer. You have to look at the developer's contractors who he's using and check that they're solid. They've got track record, because they're going to be your contractors in the event of a claim. So you have to look through the whole process.
And if the developer has cooperated with the constructor before, that's
a good sign. Yeah.
Great. So one last question, actually. Why are housing bonds not available in all European countries?
It's a matter of legislation. If it's not mandatory, developers don't buy it. It's just that it's mandatory in Spain, it's mandatory in France, in Italy, in Luxembourg, in Belgium, in other countries like
Scandinavia as well.
Scandinavia, I think Germany is not mandatory, Switzerland is not mandatory. I don't think somebody wants to spend money when it's on underwriting. But we see now for large transactions, so when when an investor buys an entire residential building, even in Germany, they ask no completion guarantees.
Sometimes they call it mandatory evil, you know,
Exactly.
because the contractor or the developer that requires it, for them it's a burden. It can be called, and then we come to them to get the money back.
Yeah.
So.
Yeah.
Luckily, we haven't arrived to like the car insurance prices are still, as Annette said, high and unprofitable.
Okay, thank you.